In this week's video, we'll review the latest charts and studies to help us answer the question, is an extended stock market setting up for a sharp correction? The first half of the video, we'll take a look at the broad market. The second half of the video, we'll review 28 charts from Friday's session that cover 15 different ETFs. In this segment of the video, we'll be covering a wide variety of market internals topics. Since most of these charts update after the close on Friday evening, we'll be using charts as of Thursday's close and thus moving very, very quickly. Clients and regular viewers may remember that these blue and orange lines tell us areas that were violated on the downside in three cases that share some similarities to the present day moving off the low in March of 2020. Those three cases, 1983 after the secular low in 1982, 2003 after a major low in October of 2002, and 2009 with a low coming in March of 2009. These violations here occur in calendar year 2010. Looking at data as of the close on Thursday, April 15th, you can see we're above all of the blue and orange lines. And even recently, you can see when we start to fall here, this is where really bad things happen in the S&P 500. This is where really bad things happen in the S&P 500. And notice where the indicator is before really bad things happen. Sometimes you get a little bit of a warning before something like this, and other times things happen relatively quickly. So right now, this looks pretty good. We just have to keep in mind that you can get plunges and this data can change quickly, telling us that if we get very, very lopsided breadth data for 1 to 3 days, that would be a big yellow or red flag for the present day market. Right now, this chart really doesn't look that concerning. It's moving in the right direction relative to this look here and this look here. You can pause your video player. Most of these charts at the front end are going to be very, very similar to the chart that we just discussed. S&P 500 is shown the bottom of your screen. You can pause your video player and take a look at this. But right now, we really don't have a lot of deterioration. We're well above the blue and orange lines. In this case, that's when things started to have problems in 2003. And in calendar year 2010 actually is where these are violated. This is the low from 2009. Notice the market here in 2015. Look where the indicator is here before bad things start to happen. We're way up here in the present day. And again, I can't emphasize enough. Things can change quickly, but they haven't changed yet. As we mentioned a few weeks ago, we have a wide variety of charts that are very, very similar to these charts, and they all look at market internals for the most part from a breadth perspective. This is concerning. This is the NASDAQ volume momentum oscillator. This big plunge here, and it really hasn't improved in any significant way. It's possible it's a look similar to this, where bad things happen from a correction standpoint in calendar year 2012. This is the NASDAQ where my cursor is. This weak look here, this plunge and this lower low would be the bad news. The good news is we're still above the orange and blue lines. If you're a bear, you'd prefer to see a look like this right here, a look like this, a look like this, or a look like this. As we've mentioned in the Twitter feed in recent days and weeks, there are some things to be concerned about and some things that are telling us really never hurts to have a defensive profit protection strategy in place, a very specific strategy, a strategy that says, if this happens, I will do this. And if this doesn't happen, I will not do anything. This is Thursday's session. TLT gapped up. And look at the volume here where my cursor is. 23 million shares, average volume 14 million. This is really not a big deal in isolation, but it's somewhat similar to this look over here on the right side of the screen. It's simply telling us to pay closer attention. Keeping in mind, things can change very, very quickly on something like this, looking at NYSE stocks greater than their 200-day exponential moving average. Case in point, here, everything looks fine here, and then really bad things happen. But we look really, really good as of the close on April 15th. Extended? Yes. Telling us to pay attention? Yes. Telling us to be open to a sharp reversal? Yes. Has it shown deterioration yet? No, it hasn't. Trade the chart in front of you. This is currently the chart in front of us. In its present form, this is glass half full. This is NASDAQ 100 stocks, greater than their 20-day exponential moving average. See, when you come down here where this problem starts, where my cursor is, look how low the indicator is. See in here where the S&P 500 has problems? Look how low the indicator is. We're way up here in the present day. Once again, things can move quickly. They can change quickly. But the last thing this indicator did was make a higher high. That's quite a bit different than this series of lower lows here before really bad things happened. These charts can have some predictive value in some cases, and in some cases they're coincident indicators. And when we say predictive value in terms of probabilities. When you look at something like this, it speaks to the probability of good things happening relative to the probability of bad things happening, and the same can be said over on the right side of the screen as of April 15th. This doesn't really tell us a whole lot about what's going to happen tomorrow. It tells us more about what the internals look like today. Everything that we said about the last chart applies to this chart. You can pause your video player. This is a weekly chart. It's a week ago, as of the close on Friday, April 9th. S&P 500 stocks greater than their 50-day exponential moving average. This is a rare look here where the blue horizontal line is. You can see we've only hit it a handful of times. We're looking at all of the data on the left side of the screen going back to 1999. Thus, it might be helpful to know how many times has it happened. Only a handful of times on the left side of the screen under date. And how did the stock market perform walking forward? Somewhat of a mixed bag on the left side of the table here. But 1 year out, 100% of the cases higher average gain, almost 12%. 2 years out, almost 26%. 3 years out, all cases higher average gain, almost 35%. 4 years out, we've got the 2004 case rolling over in 2007. 83% of the cases higher with the average gain 38.39%. The median gain almost 55%. Helping us keep an open mind on the left side of the table, especially over the next 6 months. That's not really a new message. And helping us keep an open mind about better than expected outcomes over the next 1 to 5 years. That is also a similar theme in recent videos. How about maximum drawdowns? If you wanted to capture these gains in here in the sweet spot in the table where my cursor is, wasn't exactly unicorns and rainbows in the short run. 48 calendar days out on average, the maximum drawdown was 3.75%. The median, it occurred 30 days out, 3.06%. You can see 2 of the cases really next to nothing in terms of a drawdown. And then 2 of the cases right here, the 9.84% in the 2011 case and the 6.01% in the 2020 case. That's relatively painful. The day of this signal in the present day was April 9th of 2021. The S&P 500 closed at 4128 and change. If we saw similar drawdowns in the present day, including the average and median drawdown here, this is what it would hypothetically look like on a 2021 chart. Why is this relevant? Notice the biggest drawdown right here, 9.84%, holds the low in 2021 that occurred on a closing basis and an intraday basis on the first trading day of the year. That is also a common theme. If the market pulls back, When it starts to get down into these areas here, if you've taken some profits up here or up here, the odds say, if things start to look better, in this area here, you would consider getting some of that cash back into the market. The objective, take profits high, try to redeploy the capital at lower levels if possible, while respecting that the longer-term outlook remains favorable based on what we know today. Similar situation here, S&P 500 stocks greater than their 150-day simple moving average. It is also a weekly chart in this case. Looking at all the data going back to 2002 on the left side of the screen, extremely rare to hit this blue line here. We did that close, the weekly close, Friday, April 9th. It's only happened 2 previous times. August 21st of 2009, where my cursor is, and May 10th of 2013. 1 month, 2 months, 3 months, 6 months, 1 year, 2 years, 3 years, and 4 years later, in both cases, the S&P 500 was positive walking forward. You'll notice these numbers here are relatively tame and tepid, helping us keep realistic expectations about 100% normal and to be expected volatility that occurs even within the context of the strongest bullish trends. To get to the right side of the table, 2 years out, almost a 20% gain, 3 years out on average, about a 32% gain, and 4 years out, almost 54%. The drawdowns in this case were relatively muted. They occurred on average 29 days from the date of the signal, which hypothetically would be May 7th of 2021. And the average 1 year drawdown was 3.38%. And once again, hypothetically, this is what those drawdowns would look like, including the average drawdown on a 2021 chart based on the date of the signal, which was April 9th of 2021. None of this predicts anything. It simply gives us reference points relative to bullish probabilities and bearish probabilities. This is the Ridex bull-bear ratio. Moral of the story, you can see the ratio starts to spike. This is massive fear. This is a massive fear spike. S&P 500, really bad things happening here. Notice the spike and a trend break here occur in the relatively early stages. If we look at the right side of the screen as of April 14th in this case, because this data updates the next business day, that's what NBD means right here where my cursor is. As you can see, we do not have a spike in fear at this point. Like many of the charts that we covered, things can change very, very quickly. So when you have an extended market, what could cause something like this to happen? Some type of news event that is quote-unquote unexpected. This type of look here, a sleepy look, a lot of the extended looks that we have tell us that the market is vulnerable to bad news potentially. We trade the chart in front of us. This is the chart in front of us, and it really doesn't look bad at this point. S&P 500 stocks greater than our 150-day simple moving average. Only 2 times in the last 19 years, and once again, we're looking at all of the data. It goes back to 2002 on the left side of your screen here. We hit this level on April 15th, 2021, so very, very recent signal. The only other time, September 16th of 2009. And in both cases, you moved from a very, very oversold level where my cursor is, a very, very oversold level where my cursor is, and then we had a breath thrust to the upper green line. Thus, it might be helpful to know what happened from a gain and drawdown perspective and volatility perspective walking forward from September 16th of 2009. Here's the answer. We immediately had roughly a 4% drawdown right here. Then from the date of the signal, or September 16th, which would be similar to April 15th in the present day, from this point A here to this point B here, the gain was 13.89%, and that occurred over several months. And we all know that all good things must come to an end, even in a bull market. or at least they have to pause. The peak to trough drawdown here from this point A to this point B on July 2nd of 2010 was 15.99%. It undercuts this low here, and thus the drawdown from the date of the signal is a little bit larger at 4.32%, telling us it's possible that the Nordique phase is still on the table here. This table in the upper right-hand corner of the screen tells us where these numbers here come from. Top portion of your screen in blue text. April 15th, 2021 was 269 trading days from the March 2020 low. What happened after 269 trading days in the 2009 case? If you've been watching these videos since April of 2020, you know we have been tracking 2009 in many, many ways. So what this tells you is 269 trading days from the March 9th low in 2009, that would bring you to March 31st, 2010. This is where the S&P 500 was here. The intermediate term peak didn't occur until April 23rd of 2010. This was the S&P 500 level telling us after 269 trading days from the low in 2009, the rally was not over yet. The S&P 500 gained an additional 4.09% over the next 23 calendar days. From this peak, which occurred on April 23rd, 2010, had a big give back, 15.99%. And thankfully, we bottomed right before July 4th on July 2nd, 2010, and that move took 70 calendar days. Hypothetically, if we had a similar move in the present day, the market would peak 23 days from April 15th, 2021. That would be May 8th of 2021, and we would gain an additional 4%. That would bring us to about 43.40. And then if we had a 16% drawdown, hypothetically, the market would bottom on July 17th, 2021 at roughly 36.46. As always, how does this help us? It's telling us it's possible the market could continue to go higher, and it's also telling us that it's very, very possible that sometime in the next few days, weeks, or even months, history tells us some type of significant give back, let's say between 4 and 16%, is coming. I think from a common sense perspective, this is the easier concept to grasp. This is the one here that may be a little harder, that the market could still rally for an additional 23 calendar days, and conceptually, hypothetically, could get all the way to 43.41. None of this represents a prediction in any shape, form, or fashion. It simply gives us reference points that are based on human behavior, human greed, and fear. Now we'll shift to the 28 charts from Friday's session, and they'll help us with the bullet points shown on your screen. We've been using the term cross currents for several weeks. Here's an example, and we will show many of them. The shorter term trend dating back to the March 2020 low here favors home builders considerably over QQQ. The longer term trend is here, this trend line here where my cursor is. If we try to manage ITB or QQQ using this chart in isolation, we might be whipsawed into oblivion. Thus, trade the chart in front of you. Look at ITB in isolation. Is there anything particularly scary about the look of this chart from a trend perspective during Friday's session? The answer is no at this point. The concepts are going to be very similar, so we will move very, very quickly. Cross currents here. This is a rally favoring small caps. Right now, this looks like a normal retracement back to the 38.2, 50% area here. Small caps in isolation do look a little tired, but they haven't done anything really concerning. The last thing it did here was make a higher high, then we did make a lower low below this low. So this is indecisive here, but no resolution either way. That's the chart in front of us. We'll see how it plays out. And we have to manage based on multiple time frames. This looks pretty scary here for small caps. But if we switch over using SCHA, which is basically IWM for the most part, to a closer view, yes, this looks scary, but there's potential support here and here. And also, this is a normal retracement and an isolation. Nothing overly alarming yet. This is saying pay closer attention. And this sharp move here also said at this point, locking down some profits in this area here for us also made some sense. Very similar concepts here. Why are we showing a lot of the charts KRE relative to QQQ? Because QQQ is the prior leader. It is possible we are trying to see here or experience leadership changes from a longer term perspective, and that's the cross currents. KRE wins on this time frame, QQQ wins on this time frame. KRE in isolation, nothing overly alarming. This is extended here, no question, but there's a lot of support down here. Possible support. You can see financials XLF relative to QQQ. You can make an argument this is an inverse head and shoulders pattern. Even if this downtrend continues in both cases, still could be a lot of outperformance just making it back to this line here where my cursor is, or this line here. All to be determined. You can see the inverse head and shoulders type pattern a little bit more cleanly. It's possible we're forming the right shoulder here. RSP in isolation, nothing particularly alarming during Friday's session. Really, everything that we said about the last chart applies to this chart. And you'll notice in the short run, a lot of these charts have been struggling in recent weeks relative to QQQ. But their uptrends remain intact off of this area here or this area here in most cases. This is one exception. SMH has been stronger than QQQ for some time. The last thing it did was make a higher high here. The relative chart has not made a lower low. However, SMH does have somewhat of a stalled look in here, much like IWM or SCHA just says pay closer attention. You can see SP high beta relative to QQQ is a little bit further along. It's broken above this downward sloping trend line that dates back to late 2016 in isolation. Somewhat of a consolidation look, but nothing overly alarming at this point. VU is the S&P 500 or SPY or SCHX or IVV, whichever one you want to look at. Basing pattern here, breakout. Now it kind of has somewhat of a failed breakout look, but VU in isolation looks fine. The one concern would be this is getting a little bit steep here, telling us to keep an open mind about 100% normal and to be expected volatility or 100% normal and to be expected corrections or pullbacks that occur even within the context of a secular trend. And sometimes those can be very painful on the order of magnitude of 6 to let's say 16% based on history. But anything can happen. Value versus the NASDAQ 100, a basing pattern here. And you can see once again, if this basing pattern leads to a breakout and we get back here, this is a big potential outperformance move here. We'll just see how it plays out. Notice on a lot of these charts, once again, QQQ has been beating a lot of the leaders in recent weeks here where my cursor is. Remember last week we talked about a defensive undertone in the market? If QQQ is one of your short-term leaders looking back several weeks, this look on the left side of the screen is a little bit concerning because in recent weeks, QQQ has really been underperforming XLP or defensive staples. This would be the potential bad news or pay attention during Friday's session. The good news would be it looks like this held for the most part on the first pass near potential support. The other piece of good news is long-term treasury bonds, which tend to do very, very well during really large spikes in fear and when economic fear and deflationary fears pick up. TLT's not really done anything relative to QQQ. This sometimes is step 1, and this would potentially be step 2 for risk off. Similar situation here. If you looked at SP low volatility relative to QQQ, during the COVID plunge, it would be moving in this direction, trying to base a little bit, but nothing overly alarming here. But once again, this is a pay closer attention chart here relative to here. Why are we even putting up with a look like this when we know this is in play? Back to equal weight relative to QQQ, left side of the screen, equal weight S&P 500 relative to SPY, very long-term monthly on the right side of the screen. This is 2003. This is why. You can make an argument we're about right here after the 2009 low. And after a hiccup here, and this could be our hiccup, the outperformance was significant. And that would apply to many ETFs that we've covered in this week's video. Small caps, banks, potentially SP high beta. And that is why, as trend followers, we were open to some of these positions here, even knowing this was the case. This look here tells us it could be dicey for a little while, and how do you handle that? Trade the chart in front of you. Manage the positions in this type of market in isolation. And that statement and all the statements apply to our approach. I really believe it's fair to say and fair to conclude the video this way. Everything that we covered at the end of last week's video, the bullet points shown on your screen, still apply. You can find last week's video a week ago today on Friday by Googling Shivako Capital Channel. The charts that we've just covered show a lot of cross currents. 1-year trends versus multiple year trends. And we all know the best way to handle that is to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.